Everyone. Thank you very much for being with us. We've got a special presentation here planned for you on the gold and silver markets, and we're going to talk a lot about the influences on those markets and what's happening right now and why prices are at record highs. And I still see people joining us, but that's okay because you will have access to the recording afterwards. So if you miss anything, that's okay. Don't worry about it. We'll get that recording out to you shortly. And do take a moment and look at our risk disclosure before we get started. And the main thing here would be use risk capital when trading, and past performance is never a guarantee of future results. Take a screenshot of that if you'd like to read all those exciting words. And in fact, let me do this real quick as well. A little bit about ourselves. We're AltaVest, and we've been doing this since 1997. We're a registered introducing brokerage firm for the last 28 years, believe it or not, trading tens of millions of contracts along the way. This is yours truly, and we'll get to the introductions in just a second, and we'll be speaking here with Mike, and these are some of our staff on the trading floor at the S&P 500 options pit. And of course, it does not look like that any longer, thanks to technology and all the electronic trading going on. We're registered with the CFTC, and we're members of the NFA, and we're located in California. And I am your host for the presentation. I am Eric Gebhard. I'm one of the co-founders of AltaVest. Since 1991, I've been licensed. I have my BS in Business Administration from University of Southern California. And let me see if I can share my webcam. Just a second here. Okay, there we go. I think that's working. Or maybe it's not. Hold on a second here.
Eric, I think you're, yeah, there you go.
Yeah, I've got there we go. Something was stuck on the screen there. Okay. And we're going to be speaking with Mike Armbruster, and you want to tell us a little bit about yourselves, Mike?
Yep, sure. Eric and I both founded AltaVest back in 1997. Wow.
Yep.
So, yep. So we'll went to the University of Kansas, also in Southern California, and so yeah, here to talk about metals, which is kind of back to our roots. We've been doing a lot of options trading on stock indices over the years, and still are quite active there. But yeah, the metals are, this is a historic move we're seeing, and people have been waiting a whole career for this type of thing, or at least talking about the possibility of a move like this. So go ahead,
Yeah, that's
Eric.
a good point. That's a good point. We've been hearing about, gold going to 10,000 and silver going to $50, and it seemed like a bit of a pipe dream, years ago. All the people that talked about that seemed like they had a loose screw, but here we are. But if you haven't heard of us before, that's okay. You may have seen us in some of these presentations in the past in various locations and some live events as well. And we often get quoted in publications. For example, here's Mike being quoted about what's going on in the S&P 500 and what's going on and how that relates to gold, talking about price targets here, gold and silver. Those targets can sometimes be useless when the momentum and the freight train of the markets has its own mind made up. But in any case, we're going to jump into the meat and potatoes here. Look at the key factors: inflation, monetary policy, central bank demand, export controls, industrial demand, and just a first peek at inflation here. That's kind of always working against us, right? It's kind of that inflation shark, always eating away at our wages. Any comment on this current situation with inflation, Mike?
Inflation is always kind of probably the first thing most people think about when it comes to precious metals, but it's probably, the forecast going forward is actually for more, at least from research firm that we track, Hedgeye, which has a inflation outlook, is actually for some disinflation, and it's really probably not the number one factor for the metals right now. And we'll get into that here a little bit more, but so there is a little bit of a glide path lower in inflation, which interestingly does have bullish implications for the metals in terms of the likelihood that treasury bond yields, long-term yields will be lower, which is a bullish tailwind for the metals. So, but
All right.
not the biggest factor, but we'll get into that.
Yeah, so inflation, the rate of change, I guess you could say, in inflation is diminishing. However, it still doesn't necessarily mean that we're getting a great deal here, folks. Our dollar is worth less and less regardless of the rate of inflation slowing off of recent highs. Kind of an astounding statistic when you think about it. What about this here, talking about adding to the cost of funding the US deficit? Any other thoughts on that?
Well, yeah, I mean, that is with rising yields in a higher inflation, the bond market typically reacts by, you know, charging the government more money to fund their deficits. So a little bit of good news in that respect is that you know, with rates coming down, that should be a little easier for the deficit. But we do have a good slide. You know, Lynn Alden makes some good points about the debt and interest rates and so on. I think it's in a couple of slides. But
yeah, and then this is just a graph here of what that looks like, debt versus the purchasing power of the dollar.
right.
Okay, and here's the slide you're referring to, I believe.
Right. So, you know, what she's talking about here, nothing stops this train. I mean, you know, spending is for the most part out of control, and efforts to rein it in keep getting stymied. You know, there's a lot of vested interests in the government spending a lot of money. But so what she's talking about here is that when the debt is so high, when interest rates are increased to, say, fight inflation and try to slow down the economy, the problem is that it increases the cost of financing the government debt faster than it does slow down the private sector. So she's making the point that the brakes that traditionally were used through the interest rate market to slow the economy and slow inflation, we can't afford to tap those brakes because it just, you know, really blows out the deficit.
Okay. Here's another graphic on the dollar losing its purchasing power, not to kind of beat the dead horse, but, you know, we're down 96% of its value since 1913 to 1920, or to 2020, I'm sorry. And then since 2020, the dollar's lost another 18% of its value. So it's pretty astounding, really. And this is interesting too. Here's a chart of gold correlated with the CPI as well as the alternate CPI. And I don't know, I guess pretty obvious here, Mike, the correlation with at least the alternate CPI and the price of gold. And what is the alternate, or the shadow CPI? Is that anything to explain there?
Well, nothing for me to explain there, but I mean, if you look at the price of gold on this chart, you know, it kind of ends with the price of gold at 2,400, and you know, today we're now at 4,477. So if you added another year to this chart, you'd probably see the price of gold probably going back above that alternate CPI line, like it's done in the past in prior bull markets. But certainly the trajectory is up.
Yep. Okay. Just a little bit of inflation humor. Here's when we were all growing up, this is what $1 million house looked like. And now this is sort of what it looks like, at least in California.
Yeah.
Central bank demand, I guess we can talk about that. Anything to point out on this chart?
Yeah, I think there is some really important things on this chart. The Chinese really started buying, accumulating gold after the financial crisis in 2008. So, you know, maybe it was just the way we responded with money printing and the bailouts may have spooked them a little bit. So they started then, and then when you had the you know, Ukraine-Russia war, one of the things that happened there was that the EU froze Russian assets, which was about a little over $200 billion worth of US treasuries sitting in Europe on, I don't remember what the exchange is or the entity that's holding that, but basically they were able to freeze those funds. And I think that event really got not only Russia or China, but countries around the world thinking, you know, I don't know how much I really want to, if I can really trust, you know, putting our reserves into US treasuries. We need to diversify. So that likely sparked an increased allocation to central banks really allocating to gold versus US
Right.
treasuries. So
And here's another graph of that here. You can see
yep,
the spike there. And yeah, it's a good point. You don't want your money and your wealth stored somewhere that it can be, I guess you could say, taken from you for, you know, whatever the reason, actually.
right.
So anyway, yeah, so here we go. Here's a monthly chart of gold. Just looking at the price here. This is updated as of just today or
Today,
yesterday. Yeah.
yep.
So parabolic move here for sure. So just to give us some context on what's been going on. And silver, just to touch base on silver.
Maybe go back that one slide. There's something to point out here. If you look back in 2008 in the financial crisis, that little dip in there, yeah, that actually when the equity markets were crashing, gold and everything, all the correlations went to one. So you even saw, while gold is a safe haven, you did see gold pull back during the market crash, but that bottom happened in November. So gold actually bottomed before the equity market and then just basically took off on a tear from there. So sometimes one of the risks to precious metals is that, hey, if there's a systemic event in the equity markets, sometimes positioning, people looking for liquidity, can cause some selling in, say, precious metals. So it's just,
Right,
if you were to ask us what is something that could go wrong, that could be something that could go wrong for the metals, at least in the short run.
right. People basically are looking for liquidation of anything to cover margin calls and other aspects of their, finances.
Right.
Okay, so here's silver. So you had the gold silver ratio just about a year ago, above 90, when silver was
Right.
in the low 30s.
Right. And yeah, so at the time, usually when you see the gold silver ratio over 90, it doesn't stay there that long, and you usually get a pretty good pop in the silver price. It has silver, even at today's price, up at $68. The gold silver ratio has come down to 65, but in 2011, at that peak around $50, the gold silver ratio had fallen all the way down to 31.
Hmm.
So the typical range is, say, 45 to maybe 90 or 120. If you drop to, assuming, if you make an assumption that gold stops moving and stays at this price, if at a gold silver ratio of 45, that projects silver to $99. And of course, if you went down to that 31 gold silver ratio back in 2011, that projects silver to 144. So even if we, chances
There's the
are
chart.
both of these metals are likely to be moving in the same direction in this environment. So if you were to drop to 45, that probably means a higher gold price, which means an even higher silver price. But just for context, silver has I guess the point is it has a lot of upside potential. We came into this year with silver around the low 30s, and now we've doubled. We're at $68. So could easily happen again
Right.
in the next year.
Okay. And what about physical demand? Talking about silver here. Any comment on some of these
Just
X
yeah,
posts and tweets?
a lot of deliveries on the COMEX silver. The COMEX is the commodity exchange in New York where the silver contracts are being traded. It's actually part of the Chicago Mercantile Exchange now. They've merged, but that's where the warehouses are, and there's been a lot of deliveries on the silver contracts. So if you buy a silver futures contract and you hold it to expiration, what happens is if you have enough cash in your account, you take delivery on that silver. And so that's been happening. And not only can you take delivery, you can choose to actually move it out of the warehouse. And it's suspected that a lot of that is happening from industrial users who are trying to supply or secure their supplies, whether it's their electronics manufacturers or whoever. I think about 55% of the current silver demand is for industrial use. But that's notable.
Right. Okay. And here's more on that same thing, same theme, I should say. 92 million ounces shipped out since October.
Right.
Wow. Okay. That sounds like a lot for sure. And this is interesting here. This is really interesting.
Very interesting. It's relatively new, at least certainly on our radar. Samsung's developed a silver-based battery that could give a car a 600-mile range, charges in 9 minutes, and I don't think they mention it here, but it also has less fire risk, a lot less. So it's like all the big knocks. I mean, why wouldn't you want a silver-based battery, even if it costs a couple $1,000s more? So that's probably something a year out. And Samsung has, I think we have another slide, but Samsung has recently contracted with a mine in Mexico for their output for the next 2 years, just trying to secure supplies. So that's coming. And,
right, they're saying 40,000 metric tons of silver demand coming in 2027, even with a moderate adoption for this new battery technology.
Right. So it's an estimate, but global production's at 25,000 metric tons. So obviously this could be a really big deal.
Let's see, here's another tidbit on that as well, talking about the breakthrough in the Samsung battery.
Right.
And here's even more on that.
I think a kilogram was about 33 ounces of silver. So, I mean, it's not an incredible amount of silver, but it's not cost prohibitive, even if it's a few $1,000s. And it looks like China may have gotten their hands on the technology for the silver-based battery. BYD, a Chinese company, I think they're the largest EV maker in the world, may be coming through with their own silver-based battery, so that's even more demand. They've got China on January 1 of 2026 has an export controls going in place where silver may not be leaving China. They have to protect their industries that require China, whether require silver, like solar panels and electronics and potentially these batteries as well.
All right. So there's even more on the same theme, I guess.
Yep. A lot of information out there.
Yeah, solid state battery using silver. Late January 26 is when they're apparently set to announce this battery program.
Maybe it's just around the corner.
Wow. Okay. This person here says they aren't bullish enough on silver. So I suppose, but that could also be why silver prices are sort of front running this news. or,
Right.
or the actual event itself. But still, there could be a long way to go. Certainly, people are talking about triple-digit silver these days. And how about this comment here from Hugh Hendry? Any thoughts on that?
Yeah, it's a interesting. You know, he made an interesting point where silver is a $1 trillion market versus you compare that to gold, which is a $29 trillion market. So if you have, you know, institutional money or, you know, coming in to invest in, say, gold versus silver, you know, a dollar invested in silver is going to make a much bigger market impact than, you know, in the, he called it the black hole of gold, $29 trillion. So, you know, that being said, gold's up 2% today. Silver's also up 2%. So it's not like gold isn't moving, but, you know, when money comes into a much smaller market like silver, he's making the point that it's a non-linear upside potential.
Right. Okay. Yeah,
And
parabolic is, I guess, the word
right,
he's looking for.
right, kind of, and we don't really cover the platinum market in this presentation, but platinum's up 5.5% today. And just to point out there, I mean, 70% of the global production in the platinum market comes from South Africa. Not exactly the most stable place in the world. They've always got union strikes, you know, to get you know, source that metal from. And the last 3 years, I believe we've been in a global production deficit for platinum. So, you know, each one of these metals has a different story. From, you know, silver's now got potential for this silver-based battery. Platinum's been in a structural deficit for a while. You've got, you know, obviously a key component of some catalytic converters. Gold has the central bank buying. So these are all demand-driven markets, but just different stories.
Right. Okay. And here's what that looks like. Silver at the moment. So
Right.
definitely a bit of a parabolic move going on right now. And that's silver. Each vertical bar there is 1 month. I remember trading it back when it was $4 and $5. I was talking to
Yeah.
someone a few weeks ago. They were saying, "Oh yeah, well, I can beat you there." It was, you know, below $1 when I was trading it. So
Right. And
anyway,
historically, you know, you know, historically, the banks have always had a big short position in silver, and they've been able, you know, quite frankly, manipulate the market. You get a rally in silver, and the banks come in and, you know, sell thousands of contracts, slam the price down. The smaller speculators pretty much get wiped out, and you know, the banks that had been doing that for years, but over the last year, these silver banks have been covering their shorts. And in fact, I think it looks like they've completely covered their short futures positions. There may be some other positions off exchange where they're basically still exposed on the short side. But you know, this post is saying JP Morgan has gone from short to long. European banks maybe still have some big shorts. You know, we don't know. That's just what they're saying here. But you know, the demand for these metals has finally overcome some of this artificial resistance, so to
suppression.
speak. Yeah.
Yeah. There's another. We talked about that briefly. The Chinese export restrictions on physical silver beginning in just a couple weeks, or 1 week really.
Right.
Let's see here. And more about silver as well. Just when you think silver has topped, think again. This move isn't a peak, it's the beginning of a hyper parabolic super cycle. So I don't know, that's hyperbolic language, I guess, but that's, I mean, you're getting hyperbolic moves. So what do you say in this case? It's appropriate. And
Yeah. So it's like, you know, right now maybe there's $30 worth of silver in an iPhone. So let's say silver prices double. Okay, increases the cost of an iPhone by another $30. Is that going to really stop people from buying an iPhone, or probably not.
Right. Okay. And just some more thoughts on gold here. Here's one of the better money managers in history, Paul Tudor Jones, talking about how all roads lead to inflation, and that's why he's long gold.
Looks like at that time he was also long Bitcoin, so that's hasn't helped him much there, but at least in recent months.
No, well, unless he got out earlier, who knows? But
Right.
kind of speaking to what we talked about just a few minutes ago, right? Looking at inflation and the relationship with gold prices. So let's see, any summary here on gold you want to run through?
Well, I don't know if people remember the last couple months ago, some of the Wall Street banks changed their model portfolio kind of allocation from the traditional 60-40 to more of a 60-20-20. So instead of stocks, bonds, and gold. I don't think many people have actually, gone to the 20% in gold yet, but that's becoming more mainstream, as including gold in as a core asset in a portfolio, especially with the way our deficits are continuing to grow. Right now Congress has is not showing any ability to cut spending, so it keeps going, I guess, until it doesn't.
Right. Okay, and a couple more bullet points here on gold.
Yeah, just the whole, debasement with the money printing, and there's no sign of foreign central banks, stopping their purchases of gold. They're not stepping up their purchases of U.S. Treasuries at all. So that's definitely bullish there. And then
Right.
I know gold has also been part of the settlement process in some of the BRICS countries trading. So.
Okay, here's a question for all of us. What's the best performing asset in the last 20 years? And by the way, feel free to add any thoughts or comments or questions in the chat or whatever it might be. We can certainly respond at the end. But here's a graph of 3 assets. You've got gold, the S&P 500, and the Russell 2000. So your large cap, small cap, and then gold. And gold is certainly in the last year here running a strong race and leading the charge. So you can see here, after the financial crisis, gold took off and left everything in the dust. But then we all kind of, I guess you could say, consolidated a bit, and now here we are. So that's kind of, I don't know, I think it provides some context when you see things on a graph like that. And then here's where we are, in the last 2 years. So any other thoughts on the charts here?
No, I mean, I think it's
Speaks
just,
for itself.
it's surprising for most people, just because, the metals that tend to be overlooked. All the focus has always been on what the big tech stocks are doing, but.
Right, if you watch all the business shows, they're
Right.
talking about NVIDIA all day long, which is all good and well, but this has really been under the radar in many ways. So a little bit about gold and silver futures contracts. So if you're not familiar with those, maybe we'll run through some of the specifications on those and what they look like in terms of how they work.
Yeah, so these margin requirements on gold and silver have basically doubled over the last year with the price. So there is a small contract, 10-ounce futures contract in gold. Margin is $2,200. So you're able to control, about at current prices of 44.68, over nearly $45,000 worth of gold.
Right.
So
So
a lot of leverage.
$2,200 is a margin deposit.
Right. So
And
you obviously wouldn't have just that amount of cash in your account. You would, probably have at a bare minimum, $10,000. Um, and that's something that we could work out. If you have an interest in precious metals, we could devise a plan for you and what we recommend.
right, and that's micro gold. And of course, going back to gold, this is the micro contract of gold. The full size contract of gold represents 100 ounces. And that's certainly available, but then the margin is 10 times greater.
Right. So it just depends on the size of the account.
Yeah, so here's the example here on the full size gold contract. So one contract, you need 22,000 as margin.
Right. And you can also do strategies with a full-size contract, like like you might do with an equity, where you have a caller, you buy a put, and you sell a call to finance the purchase of that put to control your downside risk. So there's a lot of different things you can do.
Right, right. And we're just looking at some of the futures contracts now, but obviously we trade millions of options as well. So we can work with you on any level. Here's silver. So anything about micro silver you want to review?
Silver is more volatile than gold. Smaller market, moves more on a percentage basis typically than gold, but it does have exponential upside. One contract, the margin is more. It's close to $5,000. It reflects that volatility. So it just depends on your risk tolerance and what you want to be involved with.
Right, right. And then here's the full size silver contract. That's 5,000 ounces.
Right. Margin's 24,000. So, you're probably going to want to have a six-figure account if you're in this contract.
Right. Yeah, that's $340,000 worth of silver. You're really responsible for, I guess you could say, up or down,
Yeah.
for better or worse. And then with the gold, how much was that? 446, $450,000. So those are the full size
Yep.
contracts. So that's why we like
Yep.
the micros, and uh, they just allow you some I guess more access. You don't have to put up and tie up as much money and still have exposure to these markets.
Yeah. And you can lower your futures margin by putting an option strategy around that long futures
Right.
contract.
Okay, keep hitting the screen here. Tax efficiency, want to point that out. Lower your tax rate by up to 10% with futures and options. Remember, they're a tax efficient asset class. The IRS treats these as what they call 1256 contracts. So essentially 60% of your gains are taxed at the capital gains rate, which is probably lower than your personal income tax rate. So we did want to point that out. Here's a simple mathematical example. I don't know, you want to run through this real quick,
Uh,
or it speaks for itself?
yeah, it speaks for itself.
Yeah, but here's another advantage too. No more itemizing each trade when you're trading futures and futures options. So you'll receive your profit at the end of the year on a 1099, and that's all you need to do your taxes. You don't have to be this guy here with a desk full of paperwork, itemizing trades and wash sales and all that. But always consult your tax advisor or attorney for that type of detailed tax advice. And you can also trade with a self-directed IRA. Forbes here points out might kind of combat market volatility, investing in alternative assets through a self-directed IRA. So certainly gold and silver would be considered alternative, or anything in the commodities and future space would be considered alternative. And we work through Equity Trust with their self-directed IRAs. They've got 71 billion in assets under custody, and they will waive their setup fee for AltaVest clients. You can have any of these types of trading accounts, IRA, of course, we talked about, individual, joint, or any kind of business entity. We work with all of those. Just a little bit of gold humor there. And what else? Any other comments here, Mike? Let's see. Just to point out, we can trade any market in the future space.
Yeah, I think just to kind of summarize, the metals. I mean, these are all demand-driven markets, and those are the most powerful bull markets in commodities. And the thing about the metals is that versus say, a grain market or even a, livestock market or something like that, grains, you have a tight supply and then you have a new crop that comes in and, a bumper crop and all of a sudden prices plunge and so on and so forth. Whereas the metals, you have significant investment that needs to happen. It's not necessarily easy to dig out metals and to really ramp up supplies when you've got all of a sudden demand just, taking off, whether it's because of the new silver battery or whatever. So there's going to be a lot, there will be volatility, but the staying power of these markets is got a lot of upside potential.
Right. Okay. And then any other thoughts on reasoning or rationale for having exposure to these alternatives in your portfolio? I guess this sums it up here.
Well, yeah, in certain markets that are not, great for traditional assets, gold and silver to a certain extent tend to do well over time. Sometimes they have an inverse correlation to equities, not always. Right now, they're probably more positively correlated, but other than severe market crashes when people are selling for liquidity, gold can do quite well in that environment.
Right. Okay. Here's the biggest cheerleader of all for precious metals, Peter Schiff. He had commented, do not wait for silver to hit 100 or gold to hit 5,000 in 2026. So we'll see. He's been making the same speech for, I don't know, 25 years.
He's been consistent.
He's been, yeah. And, it's paying off for him. It took a while, but it's definitely paying off. So he might be absolutely correct about silver here, for example. But the thing is about these kind of markets, sometimes they just keep going and going and going, and you keep thinking they can't go any higher, and they continue to do so, and then you wonder, is it too late? And you have all these doubts, and then at some point you have to sort of look at yourself and do I think this is going to continue? Are all the factors and the stimulus still there? And do I want to trade this market? Do I have the risk tolerance? So on and so forth. So those are questions you have to answer. But definitely, there's a lot of movement in these markets for sure, and there's probably a lot more ahead. So
yeah, and I would say, just to add on to what you were saying there in terms of the forecast into the first half of next year for accelerating economic growth in the U.S. and that's really going to be a positive thing for demand-driven markets. So certainly over the next 6 months or so, that's it's not a doom and gloom scenario or indication at all that these markets are going higher. I mean, some people say there's something going on, something's wrong, this has never happened before. Well, maybe what's wrong is that there wasn't enough investment in these sectors. So and making, we're not going to sit here and make a price projection. There's guys like Jim Rickards out there that are talking about gold going to 10,000 or 20,000. Who knows? I mean, they may be right. And certainly it's moving quickly right now, but the trend is up and the fundamentals are strong.
Right. Okay, let's see here. If anyone has any comments or questions, feel free to ask us. But in the meantime, the way to really get in touch with us directly and we can chat with you directly is you can use the QR code right here. You've got our phone number here and our email address there. So you'll be able to reach out with us to us anytime, and we'll respond and find out what's on your mind and see if we can get you involved in trading any of these markets or maybe some other commodity market we didn't address today. But anything else, Mike?
No, that's it. I think if you email us or register, Eric and I will be happy to talk to you and see if we can put together a plan that fits your situation, and we look forward to it.
All right, well, great. Thanks everyone for being here, and hope you have a Merry Christmas and a Happy New Year. So we'll wrap it up, and we look forward to hearing from you. Bye-bye.
Bye.